And beyond the labor market, there are other signs of economic strength. We have steady income gains, rising household wealth, and elevated consumer confidence, which continue to support consumer spending, which accounts for about 2/3 of output. Business investment improved markedly last year following 2 subpar years, and both business surveys and profit expectations point to further gains ahead.
In his first official speech as chairman of the Federal Reserve, Jerome Powell painted a very optimistic picture about the current and future state of the United States economy. His April speech came just a few weeks after Powell and the Fed approved the first of an anticipated 3 short-term interest rate hikes this year. The question becomes, will it happen? And if so, can the economy and the financial markets handle it? It's time once again to tune out the hype and focus on the facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional-style investing to your portfolio. Hi, I'm David Scranton. Inflation fears, trade war fears, real war fears, and a roller coaster stock market. In the middle of all of it sits the Federal Reserve with a brand new chairman at the helm. On the very day Jerome Powell succeeded former Fed Chair Janet Yellen, the Dow fell more than 1,000 points. The timing seems to speak volumes about the challenges facing Powell as well as the Fed, some of which are completely unprecedented. We'll talk about those challenges and the potential outcomes, both good and bad. We'll get expert insights from our guests, Gregory Daco, who is the head of U.S. macroeconomics at Oxford Economics and former Ronald Reagan advisor, financial commentator, and China expert Jim Rogers. First, let's talk about the Fed's new chairman and some of the challenges he's already dealing with less than 2 months on the job. Donald Trump's nomination of Jerome Powell to replace former Fed Chairman Janet Yellen came as a bit of a surprise to many. Yes, Powell is a wealthy Republican and a former investment banker, but he's also quite a departure from some of President Trump's other radical and controversial picks for high-level posts. Essentially, he is seen as an acknowledgement by Trump and lawmakers that the Fed's leadership transition needs to be smooth, and that they simply cannot afford to risk having a new driver who might make sudden and sharp turns. The reason is obvious when you consider the delicate state of our economy, as well as the financial markets, as well as the role the Fed has played in creating that delicate state. So in a sense, Powell is charged with landing an experimental aircraft that was launched 9 years ago in response to the financial crisis. That's when the Fed, under then-Chairman Ben Bernanke, embarked on what turned out to be an historically unprecedented effort to jumpstart the economy with artificial stimulus, namely buying up U.S. treasuries and holding short-term rates near zero. Those measures and others, known as quantitative easing, were still in place when Janet Yellen took over the Fed in 2014. But eventually, the economy improved enough that she also inherited the job of tapering the program and starting the process of, quote, normalizing the Fed policy and its balance sheet once again. In other words, Yellen began preparing the artificial aircraft for landing. But that's proven to be a slow process thanks mainly to 2 factors. First, quantitative easing didn't really work as well, or should we say perhaps as quickly, as the Federal Reserve would have liked. Americans who had been burned by 2 stock market crashes in less than 10 years were reluctant to start spending and borrowing again. Companies were slow to hire and wage growth remained stagnant. Number 2, the stock market basically became addicted to artificial stimulus. Part of that was due to optimism over what easing was supposed to accomplish. But mostly it was due to those historically low interest rates. They drove a lot of everyday investors up the risk curve, meaning into the stock market, simply by making other investment options appear less attractive on a relative basis. And even though the Fed stopped its bond buying program more than 3 years ago, the stock market has continued to be driven more by artificial factors than by economic fundamentals. First, as I said, it was the launch of QE programs similar to ours in various struggling European countries. Next, of course, it was the election of President Trump. His promises to slash corporate taxes and create consistent 4% annual GDP growth were, of course, just music to Wall Street's ears. The Trump bump, as it came to be known, added another 20+% to the already artificially inflated stock market in 2017. And it continued until the beginning of February of this year, when the market experienced a shockingly quick 10% pullback. And as regular viewers know, I've always likened the Fed's overuse of quantitative easing to steroid use by an athlete. Why? Because steroids not only enhance the athlete's performance artificially, but because their negative effects continue in the athlete's body long after he stops taking them. That's why even though the third and final round of quantitative easing ended in late 2014, these negative impacts are still being felt in the financial markets today. As noted, that 10% pullback in February coincided with Jerome Powell's official takeover as Fed chair. Coincidence? Well, partly. But it's also true that in statements to lawmakers, Powell has taken a more hawkish tone than expected. In Senate testimony, he initially suggested there could be as many as 4 interest rate hikes this year, saying the thing we don't, ... is to get behind the curve, to have inflation move up and have it raise rates too quickly and therefore cause a recession. Let's face it, nobody wants to hear the dreaded R word, of course, especially not Wall Street, which of course is anxious for President Trump to deliver on this promised 4% GDP growth. In fact, you could argue they're dependent upon it in order for growth to finally catch up with today's overvalued market prices. That's what makes the situation so delicate, and frankly, it's what makes Jerome Powell's job so incredibly challenging. His predecessor's policies have created a situation in which every word he utters has the potential to prompt a market rally or a market panic. This is probably why he has backpedaled a bit on his hawkish tone. In his speech earlier this month to the Economic Club of Chicago, he advocated a, quote, patient approach to raising interest rates further. This speech came just 2 weeks after the Fed approved raising its key rate by 0.25% in its March meeting. That was the 6th such raise since late 2015, yet the rate remains very low at 1.5 to 1.75%. This slow pace to normalization is, again, because economic growth has lagged behind all the efforts of artificial stimulus and behind the overzealous stock market. And as a result, inflation has mostly remained below the Fed's target rate of 2%. And just as significantly, long-term interest rates have remained low, in part because a lot of foreign economies are not in any better shape than ours. Consequently, many are still actively using the kinds of quantitative easing measures, i.e. economic steroids, which we ended 3 years ago. And we'll talk a lot more about the significance of that later in the show. But in the end, those two factors, low inflation and low long-term interest rates, have made the Fed's efforts to get short-term rates back to normal, to say the least, challenging. Although in his speech, Powell said that they have increased confidence now that inflation will at least reach the 2% target rate this year. And for many reasons, inflation seems like it may or may not be as imminent as initially thought. But if it does happen, then how much and how quickly? And will it coincide with the 4% GDP growth and be taken as a good sign by Wall Street? Or will investors panic that higher costs could trigger a spending slowdown that leads to layoffs, and then that domino effect that results in, yes, once again, that dreaded R word, another possible recession? And then the question becomes, how can Powell and the Fed walk this fine line with so many unknowns to contend with? The prospect of a trade war, the impact of the president's tax cuts, the polarized political climate, and the president himself, whose words are the only ones as closely watched by Wall Street as Jerome Powell's. We'll talk about all that in just a bit and what it means for everyday investors in the income generation. Right now it's time to welcome our first guest, Gregory Daco, head of U.S. macroeconomics at Oxford Economics. He is responsible for producing the U.S. macroeconomic forecast using Oxford Economics' proprietary global economic model. He tracks and forecasts high-frequency indicators and oversees the production of U.S. research pieces on consumer markets, housing, business investment, international trade, labor markets, inflation, fiscal and monetary policy. Gregory, is there anything you don't do, for goodness sake? How do you do all this stuff? How do you keep it all together?
Just demands a lot of work.
A lot of work and a lot of focus. Well, you're a young fellow, so you got the energy to do it. Welcome to the show.
Thank you.
So let's start with the promise from, the election 17 months ago about attaining a 4% GDP growth rate. Earlier on the show, we talked about the fact that the Federal Reserve has recently increased 2018's projection to 2.7, next year's to 2.5, and then dropping after that. So who's right? Are we going to be able to get over 3, get closer to 4, or are we going to be stuck in the 2s?
Well, I think this year we're probably going to achieve a number that's pretty close to 3% in terms of real GDP growth. That would be the best performance in quite a few years now. If you look back at last year, that would be a significant improvement over the 2.3% advance we saw in 2017.
Right.
But it would fall short of the 4% target that the Trump administration is looking to achieve. And importantly, a large part of the growth this year is likely to come from fiscal stimulus. We expect about a fourth of the growth this year to actually come from additional fiscal stimulus, both via a reduction in taxes as well as additional government spending. So the underlying momentum for the economy is actually closer to 2.5%.
So you think then, like the Fed does, maybe the Fed was a little too conservative with 2.7 for this year, but you think that maybe 2019 might be a step down from 2018 in terms of GDP growth?
I think so. I mean, when we forecast as economic forecasters, we always say that decimals are a sense of humor. It's always hard enough to predict round numbers, but predicting the decimals is even tougher. So I think a forecast around 3% is a possibility for 2018. I do think that if we look into 2019, where we're going to see less fiscal stimulus from the tax cuts, maybe a little bit more from additional government spending, the momentum of the economy might actually slow somewhat in 2019. And if we look even a little bit further beyond 2019 into 2020, I do sense that there are signs that the economy might actually undergo somewhat of a slowdown in 2020. Now, we're still 18 to 24 months away from that, but I do think it's important to keep in consideration the fact that a lot of the growth momentum that we're going to see over the course of 2018 and 2019 will come from fiscal stimulus, and the underlying momentum of the economy may not be as strong as the headline numbers appear to show. Interesting.
So we need to take a quick commercial break. We come back, we're going to talk a little bit about what you think the Fed could do to help this out. Is the Fed being too hawkish, too dovish? Want to hear your words of wisdom as soon as we return. And for Income Generation viewers, you stay with us. We have a lot more coming up on the show. Stay with us. We'll be right back here on the Income Generation.
Does the debt and the deficit limit or contract the degrees of freedom that any central banker has?
To the extent that it impacts on the money markets, which it invariably always does, then that is a critical issue for central bankers to be concerned about.
If you're ever looking for a reliable source to discuss the challenges of the Federal Reserve, then that man is that source. Former Fed Chairman Alan Greenspan. Mr. Greenspan gave his thoughts on the obstacles facing the Fed in a recent Bloomberg interview. One that he focused on quite a lot was the almost $1 trillion federal deficit, noting that its impact on the economy is inevitable, no matter how hard politicians try to convince us otherwise. He said, until it becomes obvious that there are consequences, such as inflation, the political system doesn't respond. And as you just heard, Mr. Greenspan also pointed out that the deficit is yet another major concern for new Fed Chairman Jerome Powell as he tries to land this experimental airplane known as quantitative easing and to normalize Fed policy once again. And as mentioned in our first segment, part of that normalization process involves raising short-term interest rates, which were held near zero throughout the quantitative easing era. Powell has said the Fed is looking to approve 2 more rate hikes this year, but wants to see inflation move up and stabilize at around 2% first. But as Mr. Greenspan and others have pointed out, a lot of factors, including the deficit, are in place that could potentially push inflation up higher and faster than the Fed would like. As Powell himself has admitted, that could force them to, quote, raise short-term rates too quickly and cause a recession. The dreaded R word that once again terrifies Wall Street. So what are some of these other inflationary pressures and how do they relate to some of the additional concerns and challenges facing the Fed? Well, a big one is that new tax plan, which slashes corporate tax rates and represents a $1.5 trillion fiscal stimulus. It's going into effect at a time when the economy is already almost near full employment. What's more, according to most economists, it will add significantly to the federal deficit, despite the Trump administration's insistence that the cuts will pay for themselves through GDP growth. As Mr. Greenspan said in his Bloomberg interview, the tax plan is not bad in and of itself, but, quote, the problem is that it's unfunded. The Fed itself would seem to agree with this assessment. In their statement following their March meeting, the Fed slightly raised their forecast for 2018 GDP growth from 2.5% to 2.7%, and increased 2019's expectation from 2.1 to 2.4. However, they projected that growth is likely to cool further after that, with the 2020 forecast holding at 2% and the longer run measure just at 1.8%. We'll talk more about the pros and cons of the new tax laws, where the Fed is concerned, with my guest coming up in just a bit. Another potential landmine for the Fed, of course, is the ongoing dispute with China and other nations over tariffs and trade policies. If it results in negotiations that lead to a more equitable tariff system for everyone, then great. If, however, it results in a full-blown trade war, then most likely not so great. That could lead to significantly higher prices on a wide variety of goods, as well as increased manufacturing costs and a domino effect that brings economic growth potentially to a grinding halt. We'll talk much more about the situation with China and the potential of a trade war with our guest Jim Rogers a bit later in the show. Of course, another challenge for Powell and the Fed lies in the polarized political climate in Washington, D.C. The tax reform bill, remember, was passed without Democratic support, and so far it's the only really big piece of legislation that President Trump has been able to get through Congress. If political gridlock remains the norm for other bills and policies related to the economy, that will only increase the unprecedented levels of uncertainty already facing the Fed and make their job that much tougher. We'll find out more about what happens there in November. But regardless of how you feel about him, it's hard to deny that President Trump himself also increases that air of uncertainty with some of his words and actions. In a recent tweet, for example, he wrote, quote, Russia and China are playing the currency devaluation game as the U.S. keeps raising interest rates. Not acceptable. This tweet was interpreted by some as a criticism of the Fed's decision to approve that most recent rate hike in March. But others read it differently. But you see, it's that very lack of clarity in some of these remarks that make his presidency quite unique and also makes it a bit more challenging for Powell and the rest of the Federal Reserve. And on that note, let's welcome back Gregory Daco to get his take on the first 2 months of Jerome Powell's being in office at the helm of the Federal Reserve. Too dovish, too hawkish, or as my good friend Jeffrey Small would say, like Goldilocks, just right?
I think overall, in terms of Jerome Powell's approach to policymaking, he's more of a pragmatic. I think that so far what we've really seen is someone that looks at the data, evaluates the data, and generally concludes that the economy is doing quite well, that the pace of GDP growth is satisfactory, that employment growth remains quite solid, and that inflation is gradually moving back towards the Fed's objective of 2%. And in that environment, in those circumstances, the Fed expects to raise rates currently 3 times for 2018. We think actually they might actually go with 4 rate hikes this year, given the fact that inflation will actually probably surpass the Fed's 2% inflation target somewhere around the summer of this year.
All right, so of course now the 800-pound gorilla in the room is long-term interest rates. You know, the Fed could certainly take 3 more hikes and they can get us up in the 2.25 to 2.5 range, but then how do we know long-term interest rates are going to respond? We have, European countries now still with their stimulus. We talked earlier on the show about Spanish and Italian 10-year debt paying nearly half the interest rate that ours does, but yet with theoretically at least a higher default risk. So things are already out of equilibrium, which is why, for example, the 10-year Treasury long-term interest rates have struggled to go up. What's going to finally make long-term interest rates cooperate? I'm not seeing it.
Well, I think that if we take a broader perspective in terms of the interest rate complex, we see that essentially we have the Fed putting upward pressure on short-term interest rates via increases in the federal funds rate, and that on its own should put upward pressure on long-term rates. Now, we have seen a very slow rise in long-term rates, and indeed, the 10-year yield has taken quite a bit of time to even reach the symbolic 3% mark.
Sure.
But we do expect that with upward pressure on short-term rates, we're going to see long-term rates rise. And you have to also factor in other factors. The fact that inflation is rising generally tends to support higher long-term rates. The fact that you have a wider budget deficit stemming from the combination of the Tax Cuts and Jobs Act as well as the Bipartisan Budget Act will increase the deficit and therefore put upward pressure on long-term rates. So those factors will keep the pressure on the 10-year yield towards the upside. We cannot forget, though, that the U.S. remains the reserve currency of the world, and that in case of uncertainty around the world, whether geopolitical or economic uncertainty, capital flows back into the United States and tend to put downward pressure on long-term yields. So there are 2 opposing forces at play right now.
Right, so in the 30 seconds or so we have left in the segment, what about the flattening of the yield curve? 2 interest rate hikes ago, there was a 0.9% difference between the 2-year and the 30-year. Now it's about 0.65. They raise rates 3-4 more times. It could be 0.3, 0.4. Isn't that close to a flat yield curve?
Yeah, I think we're getting close to a flat yield curve. What really matters, though, is an inverted yield curve where long-term rates fall below short-term rates. That's generally indicative of an impending recession.
That's a real problem.
But we can't forget that that's not necessarily a sign that the recession is coming up in the next few months. You still generally have a year, maybe 18 months before a recession actually hits.
When we come back, I want to talk to you a little bit about the deficit, the national debt. How far can we go with the national debt? Can we really grow our way out of it and just keep taking on more and more debt ad infinitum? I want to get your feedback on that. And also what you would tell average investors, members of the income generation. And for you income generation members, stay with us. We have more from Gregory Daco upon our return. We'll be right back. So as we've discussed, one of the Fed's objectives for moving forward with 2 more short-term interest rate increases this year is to hit a stable inflation rate of about 2%. Well, even though it isn't talked about very much, another thing they need is for long-term interest rates to cooperate and to move up first. In fact, as we've discussed before on the show, they're actively working to achieve that goal through the so-called unwinding of quantitative easing. This is also an important part of the process of normalizing the Fed's balance sheet. Through 3 rounds of easing, the Federal Reserve purchased some $2.1 trillion of mortgage-backed securities and U.S. Treasuries. Starting last year, they began selling those bonds back in the open market. The idea, as I've explained before, is to basically flood the market, increasing the supply in order to drive prices down and drive long-term interest rates up. This unwinding process is largely why the rate on the 10-year Treasury yield jumped from 2.4 to 2.7 in January, spooking Wall Street and helping trigger that rapid 10% sell-off that we saw back then. You might think of this unwinding process as an attempt to administer an antidote to cure the lingering effects of all those economic steroid injections known as QE1, QE2, and QE3. And as we all know, sometimes an antidote works, but sometimes the antidote kills the patient instead. So for the Federal Reserve, this is one more big uncertainty. And you might also be wondering, if rising interest rates seem to rattle the market so much, then why is the Fed trying to drive them up? Well, as we've discussed before, if they move ahead with their plan to hike short-term rates up to 2.1% by the end of this year, but long-term rates remain at 3% or so as they are now, they'll be creating a flat yield curve. Banks and lending institutions depend on a positive sloping yield curve to make money. If it's not, if it's flat instead, meaning that the difference between long-term and short-term interest rates is only marginal, then those institutions lose the financial incentive to lend money. In this case, businesses and individuals won't be able to borrow, and for things like mortgage loans, car loans, small business loans, things that are all central to a healthy and growing economy. And they all depend on a positive sloping yield curve. Now, our regular viewers know that I'm on record as saying that I believe long-term rates are going to have a tough time going up. They just recently broke through the glass ceiling of 3% that's held for so long, in spite of the Fed's unwinding efforts. One reason, as we discussed earlier, is that many European countries still have quantitative easing programs in place, meaning they're still administering economic steroid injections. And as a result, in countries like Spain and Italy, for example, their bond yields are generally lower than ours. In fact, approximately half, although those countries are considered to have a much higher default risk than ours. That means that a lot of investors are still pouring money into our bond market. Why? Because it's a better option to be able to get more secure bonds at nearly double the interest rate. And as I've put it before, we in the United States, although we may not be doing as well economically as we were in the 90s and some points in the early 2000s, yes, we are still the cleanest dirty shirt in the world's economic hamper, especially when it comes to global bond investors. Now, naturally, this affects the Fed's effort to drive prices up and down because they can't flood the market when the demand for bonds remains so strong. They flood it, but the bonds end up just getting purchased right back. So their efforts to drive down the prices and drive up the interest rates become significantly hindered by what's going on abroad. Again, consider that the 10-year Treasury peaked at 2.94 at the end of February. It's 2.94%. And through all of March and most of April, it couldn't break through that rate. In fact, it was just this past week that it broke through that 2.94% again. While that creates yet another challenge for the Fed, at least it's a positive sign that the financial markets are starting to naturally normalize themselves again, even if the Fed is struggling with the process. After years of being mostly influenced by artificial factors, the markets are starting to respond to fundamental realities again. That's why long-term interest rates stabilized, as the stock market recently has gone through a series of big sell-offs and partial rebounds, followed by more sell-offs and more partial rebounds over the last 2 months. In addition to that, or maybe as a result of that, something called a flight to quality has occurred, as many of our own investors here in the U.S., under the uncertainty of equities, fled toward the relative security of bonds, once again keeping our long-term interest rates down in spite of the Federal Reserve's efforts. And what's more, I believe this trend will continue, creating yet another major challenge for Jerome Powell and for the Fed as they attempt to land this experimental airplane safely. Now it's time to welcome back Gregory Daco. Let's talk about this deficit and this debt. Politicians like to tell us we can spend our way out of it, not to worry about it, as long as we get enough growth. Our net worth as a country, if you will, is growing as long as it grows faster than our debt. But there's got to be an end to this, right? I mean, our viewers can't just take on more and more and more debt without worrying about it. And even though we are the world reserve currency, I mean, can we really do that?
Well, I think that if you look at the U.S. position right now, we're not too far from a position at which we're not really adding to the debt to GDP ratio. And that's simply because essentially our deficit is as large as the pace at which the economy grows. But if we look out over the next few years, especially the next 2 years, with the implementation of a pretty substantial series of tax cuts and additional government spending, we're going to see an increase in the budget deficit. And we expect the budget deficit to go from about 3.5% of GDP today to about 5% over the next 18 months. That on its own will put upward pressure on the debt to GDP ratio, which will likely surpass 80% in the coming months. And if we look further out with the aging of the population, the need to spend more on an aging population, to spend more on medical care, that will continue to put upward pressure on the debt and could become a real issue for private sector investment and for the economy overall.
You know, Gregory, it's kind of funny. You're kind of a young fella. It's usually the crusty old salts, the ones that are more apt to say, be more cynical and say, no, we can't keep doing that. So it'll be interesting. We have Jim Rogers coming up next. I'm going to ask Jim the same question. And we'll see, we'll plot you head to head against Jim Rogers. We'll see what he says. So where do people put their money? You know, people, members of the income generation to watch our show that are age 50 and over, you know, if long-term interest rates are going to go up to afford the Federal Reserve more room to raise short-term rates, you know, that's not the best scenario for fixed income, but it's also a bad scenario for equities. If the equity market is pricing in Trump's promise of 4% GDP growth and they're only going to get less than 3%, then that's not good for equities either. So, you know, what are people to do? I mean, put all their money in cryptocurrencies and cross their fingers and toes and hope for the best? What would you tell average middle America today?
Well, I don't necessarily know that people should take big risks with new forms of currencies, as they tend to carry quite a bit of risk, and the return is not always guaranteed, especially in the long run. But I think that if you look out, you know, over the long period of time, then it continues to be quite revenue generating to invest in a mixed portfolio, to have investment that aren't necessarily putting all of your eggs in the same basket. And so to have a blend both nationally and internationally in terms of where you invest your money, and in order to, in some ways, offset the risks that might come from the international global environment or from the domestic environment. So in that environment, I think diversification is really a key element of any investment strategy that looks into the future. And I think that while the economy might be close to the end of this cycle, we can't forget that the U.S. economy is very much pro-cyclical, and after every upcycle, there is a down cycle that is again followed by an upcycle. So we have to remain optimistic about the prospects for growth. The U.S. economy remains very much a dynamic economy, and I think it remains very much a center that will continue to attract capital flows from the international environment.
Yeah, it sounds like you're saying that, you know, it's okay to be a little lopsided in times when there's obviously a better opportunity somewhere, but especially now where everything's in question, diversify across the board, be conservative, and be smart about it. So, Gregory, thanks so much for joining us today. Time flies when you're having fun. And thank you, too, our Income Generation members. We're going to be back to wrap up today's show with a grand finale in just a minute. Welcome back to the Income Generation. I'm here with my next guest, Jim Rogers. As you well know, he's a renowned American businessman, investor, traveler, financial commentator, and author who's based in Singapore. His books include Adventure Capitalist and A Bull in China. He's chairman of Rogers Holdings and Beeland Interests and creator of Rogers International Commodities Index, as well as a co-founder of the Quantum Fund. Jim, welcome to the show.
I'm delighted to be here, David. You should not have done all that introduction.
I love your humility. I could see out of the corner of my eye your hands moving, going, no, no, not me.
I don't want to hear all that. Anyway, I'm delighted to be here. I'm delighted to see you again.
Well, it's good to have you. You know, it's funny because you were on the show somewhere around a year ago, maybe a year and a half ago at this point. It's funny because I tried to push you. I tried to talk about whether China was a bubble. We talked about, you know, their growth rate at 7% being artificially maintained, artificially stimulated. And you said, after pushing you, as any interviewer does, trying to push you into the corner, you said, Dave, you want to look at a bubble, look at the debt in the United States. We have a debt bubble over there. And then I kind of chuckled and I said, well, you got me on that. But is that why recently, you were quoted as saying something about the next bear market is likely to be the worst in your lifetime?
Well, David, yes. All I said, we're going to have bear markets again. We've always had them. Although Janet Yellen, used to be head of the Federal Reserve, says we're never going to have a bear market again. Sorry for chuckling out loud, because it's so absurd. She says we'll never have a bear market again. I know we will. And all I said was the next time it's going to be the worst in my lifetime. 2008 and 9, we had a problem because of too much debt. Well, David, you know the debt has gone up many, many times, not just in the U.S., all over the world, even China.
So what do you say to all the politicians and even some educated government-employed economists who say that, well, that's okay, we can grow our way out of it? What do you say to them?
First of all, why didn't we grow our way out of it in 2008 and 2009, if it's that simple? And second of all, I say you should resign.
Yeah. It's funny, I said to people too, when people say, well, the market has another drop, I'll just get out before it drops all the way. And I say, well, did you do it in 2008? Of course you didn't. And the same thing is true, you're right. So how long can this go? I mean, can it go as long as we have the status of the world reserve currency? Can it go that long? Or is Bitcoin for real? Should we all be buying Bitcoin and the cryptocurrencies? I mean, what?
Well, it can go. It's already gone on nearly 10 years. We've already had one of the longest bull markets we've had in recorded history, not just in the U.S., but anywhere in the world. So I don't know. Why can't it go on 18 years? I don't know. I have no idea. But I know it's got to be getting closer to the end. Interest rates are starting to go up, which often has had a negative effect on markets. Who knows which war Donald Trump will start next? Anything could go wrong. On the other hand, I'm not selling short right now, because I expect this to go on a little longer. I mean, if Donald Trump pulls off Korea, for instance, he'll get a Nobel Prize and the market will go through the roof. So there are still some things that could make it continue.
So it sounds like what you're saying is right now the market is kind of speculative, but you think it still has some more upside potential just based upon optimism, based upon some good geopolitical news and things like that. But long term, at bare minimum, it sounds like you're saying you should have one finger on the trigger. You should be careful.
There's no question the market is speculative. There's no question the market is high expensive by any measure, any historic measure. It's expensive, but it also could get more expensive. I've seen that many times in history, many places in the world. But I agree with you 100%. Be sure to be careful. Be sure to watch Newsmax because we're getting towards the end. And when the end comes, I mean, Newsmax will probably say it's time to get out, but most of the rest of us will miss it.
So what about China? We just a year and a half ago we're talking about how well China's doing, and of course now China itself is taking on debt, which is different from before. Why is that happening, and what implications might we see from that, for example, in your opinion?
Well, first of all, for many years, decades, in fact, who would lend money to Mao Zedong, for goodness sakes? So China didn't have debt for many decades. Even in 2008, when it started raining, they had money saved for a rainy day. It started raining. China started spending the money and helped save the world. But now China, they were so happy and so excited about their success. Now they have debt too. Many Chinese companies are going to go bankrupt next time around. The ones that deal with the West anyway and that have debt. And the government, Beijing, has said, we'll let people go bankrupt, which I hope they do. I wish America would let people go bankrupt.
Well, but the point is a lot of the businesses are owned by the government, so doesn't that debt, in let's say the 15 seconds or so we have left in the segment, tell us, doesn't that debt end up rolling up to the Chinese government ultimately?
If they let it happen, yes. I mean, they may step in like the U.S. government and prevent anybody going bankrupt. I hope it does wind up in the Chinese government's hands. They say they're going to let it do it. We'll see.
Well, Jim, stay with us. As soon as we come back, we want to talk about the trade wars. So stay with us, and you stay with us also here on The Income Generation. Welcome back. We're talking again with a friend of the Income Generation Show, whose introduction I have to shorten this time so he doesn't get frustrated with me. That's Singapore-based author and investment expert, Jim Rogers. So,
well, David, I'm not sure I'm an expert on anything, but thank you.
the trade war, so-called trade war. Can we win this? First of all, do you agree with the president that some of the deals we've negotiated are unfair and ideally should be fixed? Do you agree with that, first of all?
Well, let's go back. Mr. Trump says trade wars are good for America and that he can win the trade war, and that is absolutely ludicrous. Mr. Trump doesn't know history. If he does know history, he thinks he's smarter than history. Nobody can win a trade war. Even the people who think they win trade wars, if anybody ever did, loses. So the answer is no. We cannot win a trade war.
So we can't win it. But you agree that the deals we've made in the past are as lopsided as he seems to be saying, or is he just pointing to a few things that are particularly lopsided?
Do you think Mr. Trump has read the TPP? Do you think Mr. Trump has read any of those, that RAND agreement? Hundreds of people seem to have been involved in negotiating these things, and now, listen, they're bureaucrats, and I don't have much regard for bureaucrats, but still, I know Mr. Trump has not read them. I don't know why he says they're no good. I do know that the TPP has to be, anytime you have free trade or open trade, it's good for everybody. And I find it interesting that the 11 countries that stayed with it, continuing with the TPP, and are not going to let us back in, as Mr. Trump seems to think they will.
So what's the best we can hope for then with all this trade war business, in your opinion?
We hope it goes away. We hope it doesn't happen. The Chinese have been pretty restrained so far, but if they get sucked into the thing, it's going to get worse. Let's hope that cooler heads prevail. Mr. Trump seems to have calmed down a bit about the Chinese trade war anyway. Iran's a different story. That's not a trade war. If he calms down and if we can, look, if he can pull that off, if Mr. Trump gets rid of the trade war, pulls off Korea, etc., stock markets are going to go up quite a lot for the rest of the year, if he can pull these things off.
Okay. So in the 30 seconds or so we have left, tell me, do you share the concern that many have that if we really tick off China, that perhaps they might stop buying our bonds and that'll cause interest rates to spike upward? Do you think that's realistically a possibility?
I doubt very seriously they might just not reinvest their bonds, but if we know interest rates are going higher, that may be one of the reasons. Interest rates are at 35-year lows, 37-year lows. Of course interest rates are going to go higher, and it's going to hurt all of us. I don't know what's going to cause. I do know some of the things, but China, I'm not too worried about what you just outlined. Good. It would just exacerbate if it happens.
Well, that's good news because that could be detrimental if it did happen. So, Jim, thanks so much for being on the show once again. We appreciate your time today. And we appreciate all of you, too, our Income Generation viewers. We'll be right back in a minute. I'd like to take this opportunity to thank both of our guests today for joining us on another episode of The Income Generation. I'd also like to thank, of course, you, our new and returning viewers. You know, we've tackled a pretty challenging topic on today's show. But if you think understanding all the complicated factors weighing on the new Federal Reserve Chairman is tough, imagine actually trying to deal with these factors. The top job of steering the nation's economy is difficult enough in normal times. But even 92-year-old former Fed Chairman Alan Greenspan agreed in that recent Bloomberg interview. These are not normal times. And like me, Mr. Greenspan is a student of history. And also like me, he recognizes that a lot of the challenges facing the economy, the financial markets, and our political leaders today are historically unprecedented. Of course, as we learned on today's show, that's partially our own fault. Short-sighted, quick-fix policies have helped create this unprecedented age of uncertainty. Now it's up to people like Jerome Powell in his new role as Fed chairman to try to normalize the economy and the financial markets again in the midst of all this uncertainty, which is sort of like trying to land this experimental airplane in the midst of a storm. You know, for everyday investors at or near retirement, it's important to remember that we're all passengers on this airplane. And as such, I believe there's never been a more important time to reduce your market risk and to focus on asset protection and income. In other words, fasten your seatbelts. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton. Thanks again. We'll see you next week.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.